Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm speaking to you from New York City on this, the 28th day of January 2020. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. And I also want to invite you to keep sending along whatever comments you have about this show, positive or negative or anything in between. Send them along to questionsfortaylor@gmail.com. Questions, the number 4, taylor@gmail.com. And, of course, we do want to thank our sponsors for making this show economically viable. Our sponsors for this week's show, Irving Resources, Sitka Gold Corp., Hannon Metals, Novo Resources, Great Bear Resources, Gatling Exploration, TriStar Gold Resources, and Lion One Metals. I've titled today's show, Inflation or Deflation in 2020. Mark Faber, John Rubino, and Quentin Henning are my guests this week. If you define inflation as an increase in the money supply, as Austrian economists do, well, we can be pretty much 100% sure that 2020 will be an inflationary year because central banks are now committed to printing an infinite amount of money, whatever it takes to keep the party going. But where will the money go? Will it continue to move into stocks and bonds, in which case the government will likely report relatively low inflation numbers? Or with stocks extremely overvalued, from historical standards anyway, will money already in the stock market, combined with trillions of new dollars being created out of thin air, move into tangibles, starting with precious metals and the entire commodities complex and into real estate? That's kind of the scenario that Alistair McLeod and Michael Oliver have painted for us and what they're kind of looking forward to this year. Well, in just a moment, I'm going to ask John Rubino for his thoughts on that topic. And Mark Faber will be with me to dig more deeply into the pathology of Keynesian economics and why the existing dollar system is ultimately doomed. For investors, timing is of the greatest financial interest, of course. And for that, I look quite seriously to Michael Oliver, not for short-term trades, but to be sure that we're on the right side of the longer term, on the right side of the markets for the longer term. Since Michael was last on the show over the past couple of trading days at least, commodities have fallen and the dollar has risen. Both of those moves in the short term are counter to Michael's predictions. But again, Michael is talking about, what he's talking about is not short term, but longer term trends. Gold as well over the past couple of days has been weaker, which goes against Michael's longer term view for a gold bull market that takes us the first stop somewhere around $1,700. Well, as an investor as opposed to a trader, I want to be sure, as I say, to be on the right side of these major moves. Regarding equities, Michael put out a notice to his subscribers yesterday showing that from a momentum point of view, the market-leading NDX has fallen below the S&P 500. In his one-page missive, Michael said, and I quote, "Today's momentum action credibly broke the multi-point, 8-month-old uptrend. The leadership of NDX has turned. Expect the broader market's net price direction to follow." In other words, Michael believes that we are at the end of the bull market for equities. Well, will that mean then that we are heading into commodity inflation, as some of our guests have argued? Well, after our first commercial break, Dr. Quentin Henning will be with me to provide an update on the progress being made by Novo Resources in seeking to mine the massive conglomerate-hosted gold fields of Western Australia. I'm really looking forward to what Quentin has to say because we haven't heard a lot from that company recently. I know they're working hard. They're using some new technologies to figure out how they can mine this massive gold field economically, and I'm sure that Quentin will have some things along those lines to tell us after our first commercial break. But right now, I'm happy to tell you that John Rubino is with me. Thanks for joining me, John.
Hey, Jay. Thanks for having me on.
Well, it's just always good to have you with us. I wish we had more time so we could have you more often. John, I think it's pretty well understood. I think you would agree with this, that we're going to see trillions of dollars of new money created out of thin air. We've had many guests on this show basically come to that conclusion. The Fed can't. It wanted to. I think under the current Fed chairman, he wanted to normalize the balance sheet. He wanted to let interest rates find some sort of market discovery, but he couldn't. He tried to normalize the balance sheet. He tried to stop and unwind the balance sheet and let the market determine. But what happened? We had a scare at the end of 2018 and 2019. We at the start a pivot back to enormous money creation. So I think first of all you would agree that this is a one-way street in terms of money creation, and secondly, what happens? Where does the money flow? Does it continue to flow into the financial assets? We have this bond bubble, stock bubble. Where does it go? I guess we'd like to get your thoughts on that.
Well, when you create a ton of new money, it goes somewhere, right? It is given to someone, and they in turn spend it, and that pushes prices up, and whatever they're buying, a little more than would otherwise happen. But in this last cycle, they've created more money than ever before, and they've given it to the banking system, but it hasn't flown into the things that make up the consumer price index. In other words, government's headline inflation looks really low because all the money that we're creating has flowed into things that aren't in the consumer price index, like stocks and bonds and real estate, and they are through the roof. So if you included those things, which really, if you're an investor, the price of stocks and bonds is part of your cost of living, right? So it's a legitimate thing to include in an index that tracks the cost of living. But if they did that, then we'd already have overt inflation, not hidden inflation. We'd have 3, 4, 5, 6% rates of inflation, because really stocks were up like 30% in just the last year. And so if we put that into the consumer price index, it would be rising dramatically right now. And because of that, and as you said, the question is, does it keep on going in this direction, or does money flow out of stocks and into other things that we actually measure as inflation? And, there's no way to know that for sure, because financial asset prices are such attractive, easy things to buy if you're a rich person with a lot of extra cash. It's really easy just to load up on whatever stock is going up. On the other hand, valuation does matter, and stock valuations are now about as expensive as they've ever been. We're up to 1999, 2000 levels. And historically, when they get there, they can't go much further, because then you're just paying crazy prices for the earnings of the underlying earnings of the companies that you're buying. And then you get a crash. And Michael Pinto just wrote something that he published today that I think illustrates the situation now. For equities as a vehicle for inflation. And that is that the 5 biggest market cap stocks now account for about $5 trillion of U.S. market cap. And they're the biggest holding in all the ETFs that are out there. So you've created conditions in which you've got some wildly overvalued stocks that dominate the most popular investment vehicle out there. And when money starts, if Google stock takes a hit or whatever, or just because of valuation, they start to roll over as a group, the ETFs would be forced to sell, which exacerbates the downward pressure on stock prices, and you get a brutal bear market. So we've created conditions for that now, which means that, if financial assets roll over, then we don't have inflation in that sector anymore, and we'll see what happens. So we could easily have a couple of deflationary years according to the CPI, just because all this debt that we've taken on has bid up asset prices, and overvalued assets are kind of deflationary because they crash and pull everything down. So it's really hard to know what the next few years hold in terms of inflation. But I think it's safe to say that the next few years definitely hold volatility. In other words, things are just going to make crazy moves in lots of different directions, because we're committed, as you said, to continue to create huge amounts of new currency, continue to dump it into the market, and it has to go somewhere. And we're at a point now where it's not obvious where it should go next from the point of view of the people with that money, which means it's very unpredictable. But the amount of liquidity out there absolutely means volatility is going to go up.
Yeah, for sure. And I just want to ask you, and I should mention to our listeners, dollarcollapse.com is your website. And one of the features that I like most about your website, John, is your 10 videos. Every week you have your 10 favorite videos. And one that I watched there this past week was from Martin Armstrong. And with just a couple of minutes left here, John, I'd like to get your opinion. Martin talked about he believes that we are having an increase globally in interest rates now. That runs counter this notion. He's suggesting that the central banks are printing massive amounts of money to keep the interest rates suppressed, but nonetheless they're rising anyway because there's just a massive shortage of savings to finance the huge deficits that the U.S. government and others are running. And he's not all that bullish on gold right now. I certainly don't agree with that. But he seems to think that it's inevitable that the rates are on the rise no matter what the central banks do, and that therefore we could very easily see some tectonic changes in the major markets like the equity markets. If it's perceived that the central banks don't have control of this anymore, and the interest rates are going up no matter what they do, wouldn't that be some sort of a recipe for disaster?
Oh, yeah, because if interest rates go up, all the variable rate debt in the world is required to pay higher interest, which means governments around the world would be bankrupt. Numerous corporations would become insolvent if they had to pay much higher interest rates, and so you'd see the leverage side of the economy just grind to a halt, and that's pretty much everywhere now. Everything is the leverage side of the economy. So yeah, higher interest rates are a death knell for the current system, which means the central banks and the central governments will do everything within their power to stop rates from going up. And so the game ends when they find they can't stop rates from going up anymore. Mm-hmm. And Martin Armstrong believes we're there. Mm-hmm. And I tell you, it wouldn't surprise me if we were there, but I wouldn't want to go out on a limb and say I think that's the case. Just
you
because that central banks have proven to be a lot more powerful entities than I expected, and they're much better able to manipulate markets than I thought they would be. So, the idea that they could do it again isn't far-fetched, but at some point it has to end. They have to lose, and maybe this is the time. Yeah,
well, I think Martin pointed out that a 1% increase in Japan would mean that every amount of money they took in, every yen they took in would go towards paying interest on the debt. So, clearly the math doesn't work. When you have a debt growing much faster than income, sooner or later, even for large governments, even for world superpowers like the United States, it's going to be game over, I think. Well, John, thank you so much for being with us today. And again, it's dollarcollapse.com. Folks, go there and enjoy the articles that John posts there, and in particular, his 10 top videos each week. A lot of really great material there. John, thanks so much for being with us, and we'll look to have you on again as soon as possible.
Great. Thanks, Jay.